All right, hello everybody. Today we are going to be going over Lululemon stock, reviewing it, seeing how they score, and yeah. So I have it up right here. We are just going to go through it. So first up, cost of capital. Is it even here? Oh, they might not even have it here. Interesting. Okay, so they don't even have it here. Sometimes this thing I use doesn't have them, so I'm just going to give it 0.5 because honestly, I don't know. Target price for them is actually below their current price, which is interesting. So 0 for that. Long-term growth rate 6.9% positive, depends on industry, beating inflation. I'm still going to give them the credit for this only because they are a fairly large company. Plus, it's clothing, so like not as much of a margin, I suppose. But yeah, all right, let's get into the income statement. So let's see here. Sales growing. Yeah, oh, this is in quarters. Years. Good. Oh, let me. Operating income. Still growing. Net income looks good. Growing EPS. Yes. Total shares. Looks like it is going down, which is awesome. That is kind of an important one. It's been going down for a while too. So since 2015, I could go farther. I'm not going to, but for the past at least 9 or 10 years, they've been decreasing the amount of shares they have, which is fantastic. All right, that's it. Balance sheet. Let's see some increasing cash. Yes, we do. Assets increasing. Oh my God, yeah. Huge jump. Almost $1.5 billion jump in assets just in the past year. That's great. Short-term debt should be coverable by their cash. Oh my God, yeah. Short-term, long-term debt should be decreasing ideally. Looks like no, but both are completely coverable by their cash, which is very good. I'd still like to see it decreasing. I'm going to give that. I'm still going to 0 it. Okay, retained earnings. Positive. Yes, it is. Great. That's it for the balance sheet. Cash flow statement. Let's see some positive operating cash flow here. Looks like we got it. That is very, very positive. Okay. Investing cash flow negative. Yes. Financing cash flow negative. Yes. And free cash flow should be positive, possibly growing, which it is. Oh my God. I thought it would be a bit until a company outperformed Celsius, but it's looking like it will be this one. So use of cash, repayment of debt should be larger than issuance. It really doesn't look like they are repaying, but at the same time, they have very little debt, so I kind of get it. I'll give them a 0 for it because they aren't repaying any debt, which is kind of concerning considering they do have debt, so they should be paying for it. Repurchase of stock is negative and it's growing. At least it looks like it's growing. That is massive, in my opinion, at least. Great, great thing to see. They are issuing equity, but again, it's a fraction of what they're repurchasing, which I never understand why companies do that. Why not just You're repurchasing it and issuing it. But anyway, I'm not smart enough to know that. Let's go into the ratio. I do like to take a glance at segment history. Their sales growth is insane, all that. But ratio analysis. Looking for a good net margin, very good. Increasing would be ideal, 16, 10, 15, 13. So it's looking like it's just about the same. But the thing with net margin is stable if sales growth. Okay. The thing with net margin is, say it's still like 16% here, 15.6% here. That's not much of a difference. But at the same time, in those 2 years, if we go back to the income statement, it is the difference of 9.6 billion in sales and 6.2 billion in sales. So at the end of the day, that very slight, like 16% now is 16% of 9 billion, while in 2020 they were at 16% again, but it was for like much less in sales. So a stable, if there's sales growth and their net margin is stable, that's fantastic. All right, ROA, ROE looks like it's increasing. Wow, 42% in 1 year. That's crazy. Got that. And then long-term debt total equity decreasing. Ideally, it's looking like it isn't. 24, 31. Well, I mean, 24, 25, 27, 27. See, the thing is, their long-term debt to the total equity is like nothing, but it's more of staying the same. They had 31. I mean, that is a slight decrease. I'm giving them half. Giving them half for it. And there we go. So I think actually just because they didn't have, I'm trying to think. I'm pretty sure Celsius actually beat them. I forget what Celsius got, but we'll see. So, oh no, they didn't. No, they didn't. So 18 out of 22, 89 final score. Let's head over to the ratings table. Oh no, Celsius did beat them. Wow. Lulu 89.0 final score. There we go. So again, Lululemon's like one of my favorite companies in terms of financials. They're insane. But yeah, that's it. That is it for the score. So highly financially positive in many different ways. Even like the negatives that they had, like repayment of debt, they really don't have a lot of debt anyway. So it doesn't really, that's not too major. And then decreasing short-term, long-term debt, again, they really don't have a lot in the first place. So this decreasing isn't the most major thing in the world. And that's like the two biggest things that they lost points on, other than, again, another debt thing. But still, not a big deal. But yeah, that's it. Have a good one.